We just had Fed Day. As you know, I was hoping that the Fed would take the opportunity to really tell the market that they are in control. What happened? What did they do? And more importantly, perhaps most importantly, what did they not do? We will go through the complete laundry list. We will revisit inflation through the decades. Shout out Resi Club for that. We will give you some earnings, and we will once again talk about a rolling recession. Folks, a lot of stuff going on, but today is all about the Fed. Did they make a mistake? Should they have done something different? What are they really doing in the market? And most importantly to me, and perhaps the middle class, what did they not do? All right, so the Fed meeting, obviously we talk about three things. Number one, no rate hike. We knew that. That was a nothing burger. Number two, the announcement, the press release, really nothing interesting other than they have documented how much they are going to reduce QT, quantitative tightening. Folks, for the last, 15, 18 months, the Fed has allowed debt to mature, and they've been sucking liquidity out of the system to the tune of $90 billion a month. Coming in June, that will be greatly reduced. There was a lot of expectation that they would go from 60 billion of treasuries to 30. The Fed went an extra 5 billion. They are now only going to be allowing 25 billion to roll off. What does all of that mean? It means there will be more liquidity in the system, and it means that rates will come in. And you saw rates move quite significantly by the end of the day. I don't know if you checked out mortgages, but mortgages went down 10 basis points, 0.1, not 0.01. They went down 0.1. So again, there will be more liquidity in the system. And then number three, what did Jerome Powell do in front of the press? I have a whole long list of things that I noted. You may have noted some others, but here are mine. He did say that the next move in rates is unlikely higher. I, of course, wanted him to be more aggressive. More on that in a minute. What else did they say? He was really adamant and really got frustrated when he was asked once again about politics having influence over the Fed. He continues to say politics is not a factor. And frankly, as I've said, I think he believes that. Again, I don't think Powell has any interest in being the Fed president past his term, which gives him carte blanche to do what he believes is best. He is not pleasing a master. He is not begging for a job. He is already rich. He is playing for his reputation. So I believe that Powell believes politics aren't a factor. But there are 18 Fed presidents below him that likely want to keep their jobs. And let's not get it twisted. They are influenced by politics, in my opinion. Really, you're not influenced by politics, in my opinion, when you know your job is done. Like, I don't care, I'm not coming back, I'm already rich. Then you give a middle finger to the politicians and you just do your job. But if you want to keep the job or maybe get promoted and go from Fed president of New York or Boston to the main job, you are going to play politics. So yes, I agree. Powell himself likely not going to wilt under the pressure, but we shall see. Next, they are shrinking the balance sheet runoff. We talked about that earlier. Again, this just means more liquidity in the system. I thought it was interesting, and I think it was noteworthy, that the market was expecting Treasury roll-off to go from 60 billion to 30 billion. Instead, they went to 25. The Fed knew what the market expected, and they gave it an extra 5 billion. You got to really watch what the Fed is doing when they go beyond expectations. They're sending a signal that they want more liquidity in the system. Next, the Fed doesn't see stagflation. This is really starting to swirl in the media. And of course, Jerome Powell in front of the press gave a pretty good line, like, I don't see stag and I don't see inflation. What he means by that is the economy is going great, 3% growth or whatever it is. That is certainly not below trend. Inflation is running at 3% and hopefully trending lower. So I appreciate where he's coming from. We've had some more recent data this morning, so we shall see if stagflation is out there. It is the worst case scenario. I do think you need to prepare and think about it because, again, if you go back and look at the 70s, it wasn't a great and thriving economy. So it warrants being on guard, but Powell was very clear he doesn't see stagflation. Next, as soon as Jerome Powell basically said, Jerome Powell yesterday was dovish and dovish and dovish. I believe he made a tactical error. I believe he had an opportunity to take control of the narrative and he missed it. Basically, what happened? Basically, the market heard risk on. My big takeaway from the miss yesterday is the rich got richer. He had an opportunity to level set the market, to shock the market, to give something back to the middle class, and he missed it, in my opinion. By going risk on, the folks with assets already get richer, and it makes it harder for the folks coming up. That is an unfortunate reality of what I saw and heard and read yesterday. He did acknowledge that inflation is still a problem. He said that it's taking a little bit longer than expected. The Fed is watching the labor market. When I heard him talk about the labor market during the Q&A, it started to feel to me that the labor market is the thing that would really cause rapid rate cuts, right? There's an old saying with the Fed that rates go up on the escalator and rates go down in the elevator. I believe what he is telling all of us is if the job market breaks the wrong way, we are going into an elevator. We aren't talking one cut. We're talking 50 basis points. We're talking successive cuts. That is what I think he is. He's trying to give us the playbook for the future. So again, as we do every week, we watch weekly unemployment claims, and we will tune in tomorrow for the jobs number for April. And then lastly, he did say there's no clear path to cuts. So, okay, again, my opinion, the Fed was dovish. I can't believe it, frankly, pisses me off that Jerome Powell was dovish yesterday. He had a chance. I believe that yesterday's Fed meeting was his last chance to take hold of the narrative that I'm in charge, no one bosses me around, and if we have to go higher, we will go higher. He didn't do that. He did give one little soft, lame line. The next move is unlikely higher. That's the only thing I can grab on. At least he didn't take it off the table completely, but man, it will be interesting. I will be looking forward to what's called the Fed minutes. We get the Fed minutes, I think, in 3 weeks. I wonder, is Michelle Bowman, right? Michelle Bowman is the first Fed president to say rates going up. I wonder how much talk there was about rates going up. Because maybe what we saw was Powell going rogue again. And maybe, again, just maybe, there are other Fed presidents going, you know what? We might have to go higher. And then lastly, folks, very clear. I do not think the Fed should go higher. I just think they need the threat of going higher. And because they took that off the table, risk on, market up, bonds down. It's party time for the rich. What else do we got? QT, okay, we talked about that. How about some earnings? We've got some earnings to look at. Carvana. Man, remember there was talk about Carvana going bankrupt? Well, they just had a record results. They beat top line, they beat bottom line, and doing quite well. Wayfair, another pandemic darling, beat top line, beat bottom line. Year-on-year customer growth of 3%. Peloton, Peloton, yikes. Missed top line, missed bottom line. CEO is stepping out, laying off 15% or 400 people. So again, folks, one of the things that this really looks like to me is the rolling recession. Remember, a rolling recession. Some parts of the economy get whacked while others perform. Then the ones that get whacked come back as others weaken. Why do I bring that up? Think Carvana, Wayfair. Carvana, Wayfair whacked last year. Horrible numbers. Shrinking. Threat of bankruptcy. Now, Carvana, Wayfair, record results, exceeding expectations. Could Carvana and Wayfair be signals that what was weak and horrible a year, 18 months ago, is starting to baseline and improve, while maybe other parts of the economy pull back, like travel or hotels? This is rolling recession playbook 101 that we should be paying attention to. How about Florida? Man, Florida real estate market is going to be one to watch. If you are in the Florida market, know that you better be watching your buy box, you better be adjusting your searches, you better be writing aggressive offers, right? Disrespectful offers. I got a report from Redfin. 5,600 active listings in Florida have the words motivated, have the word motivated in the description. Folks, this is like 2010, where it flipped from a seller's market to a buyer's market. If you are in Florida and you are shopping, it is time for you to be aggressive, right? You don't need every deal. You need one great deal. Now, again, what is going on in Florida and perhaps Texas is not the rest of the country. Most of you have buy boxes that are below the median and still on fire. But again, if you want to learn how markets turn, watch Florida. It is pretty wild. And again, what I would be watching for your area is days on market. For example, in Florida, days on market 2 years ago, 24 days on market. That anything sub 30 is fast. What is it today? 57 days on market. Folks, if Florida goes to over 60, that is when, in my opinion, you have a true buyer's market, not a seller's market. So again, lots of stuff going on there. What else? Oh, let's talk about inflation through the decades. Again, this is something that I've been talking about for years. It is my personal opinion that we saw a decade worth of appreciation in homes, and we are going to be basically flat for the rest of the decade. Here's inflation through the decades, just to give you some context. 1990, we had 33, I'm just going to round. I'm not going to give you round numbers. 33% inflation for the decade. 2000s, 29% through the decades. 2010, 19%. 2020s, we are only 4 years in, we have already had 20%. So in 4 years, we have already seen more inflation than the entire last decade. And then folks, it is Thursday, so we have to talk about weekly unemployment claims. It again came in low. Last was 212. Last was 208. Expectation was 212. Came in at 208. So the job market doesn't appear to be cracking just yet. We did get another inflationary report today, this one called unit labor cost. Unit labor cost was estimated to be 4%. It actually came in at 4.7. Another hot wage report. So again, folks, a lot of stuff going on today. We are obviously going to be watching the employment report tomorrow. I think expectations are 200,000 jobs. We will see what's what, full-time, part-time, where are the jobs, all of that good stuff. But lastly, folks, we have someone to congratulate. Kashif, congratulations on getting your next deal. I think you said this is number 3. It might be number 4. Folks, at this channel, we celebrate when people get deals. When you do the hard work and you get a great deal, we will send you a card. We will give you a shout out on the daily financial news. Kashif, congratulations. Keep doing the work. Your card will be in the mail. We give 3 types of cards. Black cards. You can get as many of these as you want. We have something called the golden ticket for your first deal. And for the folks that are stuck, frustrated, analysis paralysis, we have created a purple card for your first disrespectful offer. All you have to do is send me an email off my website, or you can DM me on Instagram. Give me your address. I will send you a card. And lastly, I'm an easy grader. I want you to win. I want you to do the work. I want you to get great deals. Take care. Have fun. Later.